Repo stress is back, and the three most important voices in America's monetary machine are all very worried about the repo market. And this timeline of events should raise major alarm bells. So, yes, SOFR stress, repo market stress is back. But what matters even more is the timeline of events and what some of the most important, powerful people when it comes to monetary plumbing, what they all are saying. Jerome Powell, chairman of the Federal Reserve, both the former and the current SOMA manager, that is basically the system open market account for the Fed. That is the bulk of their balance sheet. The former and current manager, what they are coming out and saying about the repo market, and of course, that $1.8 trillion highly levered basis trade. We'll get to all of it. Really, I think the big picture here is the major story. So just to zoom in a bit, we can see SOFR for yesterday, 3.98%. That is 2 basis points below the Fed's upper bound. Now, two important points here. Number one, we are not above the upper bound yet, but we are moving higher. And number two, it is normal to have liquidity stress at the end of the quarter or at tax deadline, these sort of settlement dates or window dressing at the end of the quarter. However, the SOFR spread right now, or rather yesterday, not end of quarter, not end of month, not a tax deadline, it is just as wide as it was at the end of Q3, Q4, higher even than Q1 of 25, Q2 of 25, and right in line with the end of Q3 of 2025. So I think that big picture is really what matters, as does this timeline. So you will recall on 10/14, Jerome Powell made some very, very unusual comments about the repo market and about SOFR spreads. Here I will put the screenshot of the transcript so you can pause it and read it. But he commented very unusually on SOFR spreads and the repo market, which is normally not something that the chairman of the Federal Reserve comments on. Then, just a day later, the Federal Reserve released a report showing the basis trade, this highly levered 50 to 1, 100 to 1 levered hedge fund trade in the Cayman Islands, was responsible for 40% of all U.S. Treasury purchases. And from that report, I'm going to quote one particular sentence here. The basis trade was partly unwound in March of 2020 in response to significant strains in the Treasury and repo markets, but has increased again in recent years, likely surpassing the highest level back in 2019 and 2020. Basically saying, look, this trade blew up before, and it blew up due to repo market stress. Well, then you go back, and it makes a lot more sense why Jerome Powell gave those comments just a day before, very unusual comments about firming repo rates and liquidity starting to tighten. But it gets worse. So then on October 31st, Lorie Logan, the former SOMA manager, now the SOMA, for those that are not aware, this makes up the bulk of the Federal Reserve balance sheet. That is the easiest way to think about it. Very, very important voice here. Lorie Logan, the former SOMA manager, comes out and says that asset purchases must return if repo rates do not soften. Now, those longtime viewers of the channel will remember her comments because we had them front and center on this particular chart for many, many different videos. Because again, Lorie Logan, the former SOMA manager, when she speaks, everyone should listen. So that was October 31st. Then just yesterday, Roberto Perli, who is the current SOMA manager, came out and said reserves are no longer abundant. And if you're curious, you can pause the video here. He says stable repo market conditions are in everyone's interest. There is strong evidence that bank reserves are no longer abundant. Again, basically liquidity is tightening and Fed balance sheet expansion must come soon, as you can see at the top there. So again, the timeline, the big picture, Jerome Powell comes out and says some very unusual comments about the normal, pretty quiet, wonky sort of repo market and SOFR spreads that the chairman of the Federal Reserve normally doesn't comment on. But then just a day later, that Fed report comes out showing, hey, this $1.8 trillion basis trade, which has blown up before, It is responsible for about 40% of all US Treasury purchases. And remember, it blew up due to SOFR stress, due to in response to significant strains in Treasury and repo markets, but has gotten even bigger in recent years, even larger than it was back then when it blew up before. So now it's all starting to make a lot more sense. Then again, Logan and Perli, both the former and the current SOMA manager, come out and make comments about, again, the repo market, which is normally a very wonky sort of thing. Normally, you don't hear, especially the chairman of the Federal Reserve, commenting on something as mundane and wonky as SOFR spreads and the repo market. So hopefully, I will link to this report. By the way, if you missed our Cayman Islands video, I would highly recommend watching that. We explain what the basis trade is and all of that. Here, again, as a reminder, reverse repo minus the standing repo shows that we have moved from a reserve abundant sort of environment, a liquidity abundant sort of environment, to one of scarce liquidity. So you take the reverse repo, you subtract out that standing repo, we can see it is going negative for the first time, going all the way back to 2020. Now, if we look, the Treasury General account, the government's checking account that they have at the Federal Reserve, we were supposed to build that up to about $850 billion. However, we overshot due to the government shutdown. Well, remember, that is removing liquidity from the system. And this is part of the reason we started to flag a coming liquidity crisis back in June and July. Was back when he announced he was going to rebuild the TGA. Well, I looked at the reverse repo, went, there's not enough money to rebuild $500 billion into the TGA, so it's got to come from bank reserves. It was all very straightforward. And as we can see, bank reserves inverted. So as the green line is going up, bank reserves are getting less abundant. The level of bank reserves is declining. That directly correlates with the SOFR RRP spread, as we can see there in yellow. And by the way, it also corresponds to the breakout in gold. So that parabolic rise in gold happened basically to the day, about the same period of time that SOFR RRP spread started to really widen out. So also, I want to point out that bank reserves as a share of the money supply, 13%. Now, the last time that reached 13%, as we flagged in previous videos, you had 3 of the 4 largest bank failures in U.S. history, followed just very shortly thereafter, of course, the regional banking crisis. Now, I want to go over here to a tweet that Andy Constant put out. He said he's normally very bullish and fades a lot of concern about things like, for example, repo stress. He goes, I pride myself as being cautious in avoiding hyperbole and FOMO or panic. Not worried about money markets, for instance, when many on here did panic. But with equities at near all-time highs and big banks at all-time highs with credit spreads the level of concern shown by the Fed, Perli comments he mentions that we went over just now, and all the admins pump and talk of late, I'm actually getting a bit nervous. I rarely say this, but I am not worried, but policymakers seem very worried. What do they fear? I would highly recommend, by the way, going through and reading Brent's comments, which were highly insightful. And by the way, just so you can see some verification here, here is 1112, and we can see that SOFR is starting to rise again. Again, what really matters relative to the reverse repo, relative to IORB, whichever spread you want to use, or you can even use federal funds, which, by the way, I will point out, liquidity has been tightening in the unsecured overnight repo market as well. That Fed funds interbank unsecured market, we can see Fed funds has actually moved higher by 4 basis points relative to the reverse repo. Now, the Fed funds corridor is not the discount window rate as the upper bound. It is IORB, which right now is at 3.9%. Well, we are only 3 basis points below the Fed's upper bound for the federal funds rate. But again, one of the comments made, I think it was by Lorie Logan, it might have been Roberto Perli, said, the Fed funds is not what matters anymore. What really matters is SOFR. I believe it was either Perli or Lorie Logan. And again, the timeline here is really, I think, the big picture story, I think, is really what matters, and what Andy was hinting at, which is, look, the people that know things, SOMA manager, current SOMA manager, former SOMA manager, and the Federal Reserve chairman, all seem very worried. Why are they so worried when, again, the stocks are at all time highs, credit spreads relatively tight? He cites a couple metrics that show, look, to me it looks like everything's fine, but the people that would know if there's an issue, they all seem very worried. And of course, Jerome Powell giving those unusual comments, and then just a day later, that report coming out showing the $1.8 trillion basis trade. And again, in the report, it points out the last time that basis trade blew up was due to repo market stress. It was all one thing. And that basis trade is now even larger than it was back in 2019 and 2020. So it makes a lot more sense. Again, the people that know things are quite worried, and they keep mentioning SOFR spreads. They keep mentioning the repo market. Now, SRF, the Fed's emergency liquidity backstop, we can see that got tapped this morning for $3.9 billion. Yesterday afternoon, nothing happened. Yesterday morning, $6 billion. So the SRF is starting to increase in terms of usage. I will link this in the description as well. I will also link the SOMA, the article that the New York Fed has on SOMA, so you can read more about that if you are interested. But again, the real story here is, I think, zooming out, putting all the pieces together, which it took me a little while to realize. Powell's comments came just one day before the Fed released that shocking, utterly unbelievable report showing that about half of all U.S. debt issued in the past 3 years was bought by 100-to-1 levered hedge funds in a tax haven. And of course, he notes in this report, the basis trade was partly unwound in response to significant strains in the repo market. Because again, remember, the basis could go the right way. The underlying trade could go the right way, but it's financed in the repo market. So if the financing leg of the basis trade, if that SOFR, those SOFR spreads, if that part starts to go against you, well, the funding side of your highly levered basis trade could cause a forced unwind. Just imagine 1.8 trillion in forced U.S. Treasury selling. Because again, the basis trade, you are short the futures, long the cash Treasury. So if it were to get unwound, your position, your trade would mean forced selling of 1.8 trillion of U.S. Treasury. So anyways, hopefully that was helpful.